Hello, I'm John Levy of John B. Levy Company. Welcome to our continuing series of podcasts on the commercial real estate finance markets. At the time of our last podcast in early January of this year, we were hopeful that the carnage from the fourth quarter of 2008 was over, and that perhaps we would see a small, gradual, slow improvement forthcoming in the new year. We were wrong. January and February of this year, 2009, were as bad as anything we saw last year. If you were looking for real estate activity in the first quarter of this year, whether from sales or refinancings, they didn't happen. As one of our partners said, in this market, there's no penalty for indecision. Buyers didn't buy and sellers didn't sell. It's early spring now as we tape this, and everyone, including us, would like to be a tad optimistic. After all, the snow is melting, flowers are coming up, and just nobody wants to be in a down in the dumps mentality. To be sure, a number of our clients feel like the good old day markets of 2007 are just around the corner and can't be far off. But from our point of view, that reminds me of that old country song, Rose-Colored Glasses. If you're one of those who is looking through rose-colored glasses, let us offer a couple of sobering thoughts. First, in the top 100 largest markets in the U.S., 90 of those markets are still showing job losses. So this recession is not just deep, but it's extremely wide. 90 out of the top 100 are still losing jobs. And keep in mind that jobs are what create occupancy in multifamily, they create office occupancy and retail. Secondly, remember that commercial real estate is a lagging sector, not a leading sector. For example, in 2007, when the subprime residential market was going over Niagara Falls backwards in a canoe, we were doing fine. So don't look for commercial real estate to lead us out of a recession. We'll be a lagging sector of the economy. There's a lot to read and think about today, and frankly, it's all very confusing, at least to us. I rather like a thought from George Bernard Shaw, who said, if all the economists were laid end to end, they still couldn't reach a conclusion. And there are days when I feel that he was right on. But in spite of that, I think that thoughtful analysts today, real estate owners, real estate developers, investors, are beginning to realize that commercial real estate is not going to recover in 2009, probably not going to recover in 2010, and may begin to recover in 2011. In other words, we are in a down market for at least 2 years. Quite honestly, it's really hard to be optimistic in this market. That said, we'd like to cite two positive examples, perhaps the rose among the thorns, that are happening today even though they're both somewhat nascent. First, the federal government is pushing massive liquidity into the commercial real estate and other markets. You've all heard of the TARP and the TALF programs, better known by some wags on Wall Street as No Banker Left Behind acts. But they are starting to show promise. and they are pushing liquidity and propping up Wall Street. As an example, AAA CMBS spreads have tightened more than 500 basis points. That being said, they've got a long way to go, but they're headed in the right direction. Secondly, later this year, we just might see the rebirth of CMBS and securitizations. We suspect it will be a single borrower transaction, a low leverage transaction, but nevertheless a huge step in the right direction of bringing securitization and commercial real estate back together. So, what's the biggest problem that most developers and owners face today? It's simple. They have maturing loans and a lack of financing opportunities. Let me put some numbers to that. Almost $300 billion in commercial real estate loans is coming due during 2009. Interestingly, less than $20 billion of that almost $300 billion, less than $20 billion is actually CMBS. The biggest part of that, more than $200 billion, is coming from bank loans. If you have a loan that matures during 2009, we recommend 3 very simple steps. First, and this is both somewhat self-serving and uncomfortable to me, hire an expert to assist you with putting the financial package together and the strategy and the negotiations. Today's market is no time to be out there alone. We're in uncharted waters. You need help. Step 2. If your property suffers from negative cash flow, don't keep the note current with your personal cash. Save the cash as a principal payment or as additional collateral for the upcoming negotiations and hopeful loan extension. Step 3. If your loan is a CMBS loan, ask in writing, not over the phone, but ask in writing for your loan to be transferred from the master servicer to the special servicer. Keep in mind, only the special servicer can extend the loan or offer forbearance. The master servicer does not have that ability. Thanks from all of us at John B. Levy Company for watching this podcast. If you have thoughts or comments, please feel free to share them with us. By email, we can be reached at jlevy@jblevyco.com, or if you prefer, our office number is 804-644-2000, and my extension is 237. Thank you.